calculating the max profit. Thank you, Ilya. I think it's recording now, is it? Yeah. Awesome. So the $700 profit is the max profit. But let's say you wanted to scalp a spread. I don't usually do it, but you can. Let's say Amazon moves up 20 points. Now the catch here is the delta on the 34 and 3410 will be the same, right? So when you look at the delta here on 3400, the delta on $3,400 is 39 cents and 3410 is 36 cents. So every $1 Amazon will move up. You're only making the 3-cent difference on your spread, right? So let's say if Amazon goes up 20 points the same day. Let's see what the $3,400 calls will be at. $3,400 calls will be at 26 plus, I'm just gonna choose a random number. If it goes up 20 points, let's say we add another $10 premium to it, for example. So the calls are trading at 36 bucks and the 34 $10 calls we're trading at 23 plus, let's say $9.25 it goes up by, right? Which will be 32.25, right? So this basically leaves you with a profit of 36 minus 32.25, which equals $3.75. Now you have to understand one thing here. 75-cent increase in $3 is not a lot of money, but the $10 increase in 26 seems to be same. But here's where people don't understand. What matters is the percentage. Percentage matters. $10 increase to 26. If we were to calculate the percentage, it's 26 to 36 would be, it's an increase of 38%. Now let's look at how much this increased by 375, right? This is an increase of 25%. Now, obviously these numbers, I'm just making them up according to my knowledge, like they're not accurate, obviously. But at the same time, with a small account, you were able to take advantage of playing Amazon with a spread, right? You didn't put in too much money, but you thought Amazon was gonna go up and you were able to, make that money a little bit, which is still a lot of money. So this is how you can play spreads on big names. Now, let's say, for example, if you think Amazon is, is gonna make a 100-point move, like next week, not a 40-point move, for example, if you wanna take a little bit of risk, you think Amazon makes a big move, right? A lot of spreads went up over 1,000, 2,000% last week, right? How exactly would you do that? So let's look into those. So what you basically do is, if Amazon's currently trading at, now Amazon current price is 33.72, and you believe Amazon goes past or 3,500 for next week, just for an example, right? You don't want to play calls, you have a small account, but you want to take advantage of this huge move. How can you do it? All right, let's look into this. So what you do is you move your spread further out. So if you think it goes 3,500, but you still want to play a little bit safe, let's look at the 3450 calls. 3450 calls are going for 1340. So 3450, they're going for 30. I'll just keep $13. And then if you think it makes a bigger move, these are going for $13. And now you can play a spread of a 10-point spread, 20-point spread. That's up to you. The bigger gap you choose, the more money you will pay, because the call that you're selling, it will cost less, right? So you'll be paying more for your spread, basically. And so 3450 is going for 13, and let's say we do a 20-point spread, 3470 here, and 3470 is going for $10. Right now, what's your math? Now this spread's gonna cost you 13 minus 10, which equals $3 or $300. Your maximum profit on this is the difference between two strikes. So 3470 minus 3450, which is 20. And your max profit is $2,000, right? Now, what's the maximum percentage gain on this? If if you look at it, so 300 to 2,000 is more than 600% gain, I believe, right? So no, it's 566. So 566% gain on the spread that you can have if Amazon closes at 3,500. But the downside to this is, let's say if Amazon does nothing, it just stays sideways. Just like calls lose premium, your spread will also lose premium. Why? Because 3450s will go down, and so will the 3470s. and you paid $3 for the spread, well, guess what? Your spread may now be worth $2.70 the next day, and then $2 or $1, right? And sometimes the best thing about spreads is, let's say if you're playing it, you can keep the calls that you bought, and you think if the stock's gonna make a move back up, the calls which you sold, the 34.70, you can buy them back at cheaper, right? Locking in the net profit here, and then you hold on to this. But then this becomes risky if it doesn't work out in your favor. Now you lose your $3 which you paid, and plus the money which you paid to buy back the 34.70, right? Am I making sense here, guys? Is this clear, or do I need to go in more details?
Very clear.
Right. If you did not understand what I'm trying to say here, just okay. So Gautam, your broker allows you to do spreads. So calls and puts is not just buying calls and puts. Yes, you can sell a call which you don't have, as long as you have the margin account and you have the options level activated on your broker. It depends on your broker. You just have to call them, right? And so basically, these are called spreads, and there's an option in your so for example, if I go into Questrade, see how I have calls and puts here. If I click down, calls, puts, vertical call spreads, calendar, diagonal, these are different strategies which you could do, right? Right now, I'm only teaching you guys spreads here, but then you can buy call, sell it, put, and then buy another call, which is usually a sell two puts. These are called butterflies. When you're playing a range, like I'll also show you guys what this is in a bit, right? But yeah, there is no downside. Bucky, the thing with the spreads, basically, yeah, I'll repeat again. So you buy one call closer to the money or in the money, right? Closer to the money or in the money. And then the second strike, you sell one call higher than the strike which you bought. So if you bought a strike, for example, if your strike here is 25, your selling call will be greater than 25, right? It has to be the bigger than 25. And that money that you sell, you use to finance your $25 strike call. So here I'll take Amazon out of this. I'll just go over example again. Ricky, no, Joseph, that's basically just sometimes if the stock's not liquid and there are not that many people playing it, only then the premiums are sometimes up and down. And those kind of stocks completely avoided if unless you understand the premium and you understand the worth of the call which you're buying and why you're buying it. Right? Many times you'll see $100 stock, let's say a stock's trading at $100, right? But you'll see that both of the stocks with a $105 strike price for options is different. Why is that? Right? You have to ask yourself all these questions because the volatility of $100 stock is different than the other $100 stock, right? So this $100 stock maybe got here from 50 to 100 within 3 months, while the other stock has been trading at 100 for 2 years, or maybe it took from 50 from 50 to 100, in 2 years. So the price of options here will be expensive, and here they will be cheaper. So you need to understand all these things when you're playing stocks, right? Sometimes you guys look at all these facts, you guys look at all these options, like CCIV, for example, or thank you, bro, or GME, for example, right? All these stocks which made massive moves, and when they stalled, options were extremely expensive because of the volatility, and a lot of people lost money on those, right? And of course, many people made money too, but mostly people lost. Yes, yeah, you're right. And same thing in February and March. This is exactly what happened. Stocks were on a run from April, May till December, Jan. And everyone was making money. People that didn't know what the hell they were doing, they were making money in the market, right? But then again, in February, when the reality hit, they all gave their gains back of the last 7 month gains. They just simply gave it back to the market. Those that did not know what risk management was, or they just simply didn't expect it. They were buying options which were a lot more expensive. And then stocks were stuck in a range and they just kept losing money and kept losing money. And many of you experienced that yourself. Back to spreads. So I'm going to go over one example very slow. Okay, pay attention. So I'm going to go over bull, call, and debit spread one more time. Bull, call, debit spread. You buy one call and you sell one call. You buy one call, for example, if a stock's trading at $100, right? And I think the stock goes to maybe 103, 104, but I don't want to buy expensive calls. Maybe you buy 100, let's just say you buy a current price of the stock. Current price is also $100, right? But you want to play a little less risky. You don't want to, you're only looking for a double, nothing major. What you could do is you can even buy a $99 call in the money call, okay? And I'm going to teach you guys some tricks after on the charts, which one to buy. You know what? Let's just do that along with this. Can you guys see the chart? Let's do it live.
Yeah.
Somebody type in a ticker symbol, please. Any ticker. Apple. Okay, let's do Apple. So let's do Apple. Okay, so you guys can see my Apple chart and the notes, correct? Awesome, guys. So I'm getting a lot of tickers now. Let's just stick with one. I mean, you can apply the same to all. Okay. So we're looking at Apple right here. Okay. So I am at. So this is Apple chart. Now the thing with Apple's chart here, right on the bat, it left a little gap here and here. Usually they're filled. Maybe it's going to be filled next year, maybe this year. I don't know. A retest of 128 is likely, in my opinion, sometime in the near future. When? I don't know. For now, there's a lot of strength. They can just keep going into earnings. So let's say, for example, if I'm playing Apple, now one thing that you want to know, like by looking at this chart, here's how you know when the option price is going to be expensive. You see this move right here from 118, around 118, 119, all the way to 132 straight without any stops. Because of this, options are very expensive now on Apple. Why? Because it's just going up. The volatility has increased. It's basically pointing to a higher high, right? And people and market makers are going to take advantage of this to sell options to people. Maybe it keeps going higher and you make money on those. Yeah. Now, to play safely, let's say if you think that, whatever happens, maybe Apple might not go too high, but let's say Apple holds above 133. Maybe this week Apple holds this area right here, the blue. So let's look at how we're going to play spread on this. So Apple's current price is 132.99, right? And then let's look at Questrade Apple. So Apple 16th April. So if I'm looking at the 133 strike, the options are going for $1.75. So 135 options are going for $1.75. Right off the back, by Friday's expiry, let's say if Apple doesn't move up or down or anything, in order for me to break even, Apple, if I buy the option alone, okay, 135 plus $1.75. Apple must be 136.75 at least. Okay. And so that's just the break-even price. But Friday, in case if Apple stalls, it just goes sideways. There's no increase in premium. It's just going up and down 5, 10 cents, maybe 50 cents down. It depends. It loses premium at the same time, right? So that's your break-even price. But let's say instead of paying $1.75, you want to pay $1.35, but you think Apple maybe closes at $1.36 at least this week, right? But how do you make profit on this? So here's what we could do. So you buy the $135 call, and then we look at, sorry, $133 call, guys. My mistake. So $133.75, yeah. And we're looking at the $1.34 call. Let's see how much they're going for. There's no price here on these. They're so 134. Let's just do 135 here. So sell one. That was T in the background, by the way. $1.135 call at $1.02. Yeah. So I'm gonna buy $133 call, and I'm gonna sell 135 to finance my $133 call. So how much is this gonna cost me? $1.75 minus $1.02, which equals 0.073 or $73, right? And then I want to calculate my max profit, 135 minus 133, which is 2, and 73 to 2 or 200 in options, right? Is, let's see the percentage increase. I'm just going to show you guys something here very quickly. Is 166% plus. Now, what's 166% of on $1.75? Just for an example, right? And sometimes we look at if I was to make 166% on 465. So 466% on 175, the cost is, what was it, 465, I think? What's the math here? Okay, so around $4.65 I was trying to do it in my head. But anyways, so $1.75, if I was to make 166% gain, right? 465, so 133 plus 465 by expiry, Apple has to be 137.65. Am I making sense here so far what I'm trying to explain? Awesome. Gotham, you can just times it by 2.66. So you can basically do $1.75 times 2.66. So you basically, so if you're trying to figure 166% of like increase of 175, use that 1 in front of the thing, 266, right? Because 100% is already included when you do the math. But anyways, so the stock has to reach $1.3765 here. When you're doing the spread, what you're saying is, let's say if Apple just closes above 135, it doesn't have to reach. Even if Apple closes at 135.50 or even anything above 135 and you hold it till expiry, you're gonna walk away with $200 on $73, which is an increase of 166%, which is not bad. But let's say even if Apple closes at $1.34, yeah. Let's say if Apple closes, Apple's closing price is 134, right? So 134 minus 133, your spread value is 1, and you paid 1 minus 0.73 for the spread. You're still walking away with $27 in profit. But here, if Apple goes at 134, there's a dip in the market. If Apple decides to go down, it chills here, but comes back up. The call which you bought now is at a loss. But your spread is in profit of $27. Is this making sense? So there are a lot of ways you can play this market. It's just not buying calls and puts alone. To be right, buying calls and puts alone is extremely difficult. I've seen it for the last 10 years myself. You can ask anybody in the market, right? With those, you have to be very picky and very patient, and you cannot trade every day. So if you're doing spreads, you have an edge over the market. If the stock goes up or down or sideways, you make money. You end up becoming the house. Yeah. If it closes at 132, because your buying call was 133, your spread goes to 0. Why? Because the your 133 equals 0 by expiry, and so does 135. And 0 minus 0, I mean, your spread's worthless. But you know what? At least you don't lose a lot of money. You only lost $73 compared to $1.75, right? I play calls alone. Yes, I do. But when I play those, it's something that I want to hit major. It's not something I'm just playing for 5-10 cents unless I'm scalping, right? A few weeks ago, I played MasterCard. I sold those calls all the way up to 700-800%, right? I'll keep scaling out. Amazon last week, for example, was an example. I played calls and spreads alone, right? When I was diversifying my profits. Yeah, you just lose that $73, Nick. Okay, now I'm gonna take some questions for you guys. Something I know I'm covering everything, but let me hear what you guys have one at a time, and then let me try answering those. You guys can use the mic or type. Okay, Joseph, 134, 133 is basically so in a spread. So this is a vertical call spread I'm explaining. I basically bought the 133 calls bought and 134 sold. 133 maybe let's say they were selling at a $2. Just for example, I'll use different numbers. If you're new to spreads, just stick with the most basic. Sorry, let me just answer this. So you buy the 133 call, let's say it might be priced at $2, and the 134 might be priced at $1.50. So you basically finance this call by selling this, right? So you pay $200, you pay 200, and you collect 150 for selling the call. So your spread costs you $50 only, right? And your max profit here will be the difference between 133 and 34, which is $100 minus 50, your cost 50 is your max profit. Yeah. So Gautam, buying a call, sometimes it depends on the behavior of the stock. Let's say, for example, let's look at Amazon, the one that I played last week is fresh in my mind, right? Even Apple, this is a very different behavior right here from many days. Hasn't happened in a long time. First of all, Amazon, the first thing I want to do is zoom out, go into the weekly before playing dailies. Many of you guys make a mistake of looking at the 5-minute charts alone. The first thing you want to do is zoom out, right? And then there's monthly also, right? First thing that I want to show you guys here is on the monthly, this right here, last month, one thing that you want to know is it bounced off. Sorry, this is not the right averages which I'm using, but it's accurate here. Let me change my averages. Hold on. Uh, 21. Okay. So Amazon, first thing that you want to do is you want to zoom out of the monthly chart and see what the monthly gets. Now, technical analysis, these are not always accurate, but then again, they usually are if you look at the historical trend, right? So what you want to do is you want to look here. It closed right above the 8 EMA last month. It came down, it bounced, like it came down, but then it closed right above it. And then this month, as soon as it took the high of last month, that was the first confirmation that I got, right? And then the MACD also was sort of curling up right here. See, instead of coming down, it pointed back up, showing more strength. And then the stochastics, which I follow, everyone has their own indicator. These are just the some which I follow, was also crossing right here, showing strength. It held, it did not drop. So that was my first sign. Second, the weekly last week was it covered all the gains. There was a lot of strength. So let's look at the weekly now for more confirmation. So the weekly right here, it closed above the EMAs. If you look at these lines, you can have the 8 and 21 EMA. These are the ones that I follow on your computer along with me, right? It covered, it was just sideways for the last 3 weeks. It closed above these. And this week, as soon as it broke above the last 4 or 5 weeks, it was a bullish confirmation for me. And then also, if I was looking at the MACD, this is very bullish for Amazon. Like just according to my experience, I've been watching it for many times. It's been down, it's been coming in a downhill for the last how many months? And finally, it's about to reset, right? Amazon has been stuck in this channel for how long? It's been stuck in this channel for how long? For many months now. It's been over 1 year, right? I think it's time for it to break out, but obviously not until it closes around 3550, 3600. It's not confirmed. It can still come down. No one knows, right? But just to play this one move. So this was the weekly. And then the daily, of course. Now the daily right here, as soon as there was a cross, right, ever since I've been in sessions with you guys, I always talk later in 21 EMA. As soon as there was a cross here and there was some volume, and then obviously with all the news that came out a couple of months ago with stimulus, everything, Amazon did not really move, right, with all those positive news. NASDAQ was lagging behind S&P, many stocks were hitting highs, right? So this, it was just conviction, and then the behavior was different when I was watching it. And it didn't break down. So this move right here, that's the one I played on options alone. For entries, See, on Amazon, even I did not know that this is what was gonna happen. I did not know this was gonna happen. If I knew, I would have held my $3,200 calls, and then that loan would have been like 1,500%. They went from $12 to $170, right? But I sold mine way before. But what I did was, entry and exit, what we're talking about here. What exactly I did was, you guys see these resistance points, right? I won't draw them to point, but just accurate enough so you can just see, right? So at each time it hit resistance on Amazon, I basically scaled out and I rolled out my profits, right? This candle right here was, for me, was bearish. This red candle right here for me was bearish, and I took most of my profits. This candle right here, and then again, obviously it took highs, and then that was just showing massive strength. Amazon had not done this move in a while. This was after a long time it was doing, and then same here with this candle. 33.30, yes, that I'm gonna get to. So let's go to the 5-minute chart. Okay, 33.30 is just a tough number as resistance. So this number right here, if you were to draw this on your computer, 33.30, if you look, zoom out on the 4-hour charts, it's just one of those numbers which was tough. It just had to get through. And if you go to fib levels, you'll get that number. So 30 was resistance. Next, if you, I can't zoom into this chart. Let me go and press break. Hold on. Okay. So this was a daily candle previous day. The high here was 33.24. Okay. And you want to give it a little room for here to hold. So 33.30 here, this is my number from all these candles that you see right here when they first was breaking highs. And then if you scroll right to the number, 33.30 is the number. Next number you'll get from here is 33.72-ish from here. You see that? So when a stock makes new highs for the first time, I'll give you the tip. When a stock makes a new high on uptrend, the first rejection that it gets, that's usually the main resistance point if it gets stuck in a range. So here, for example, Amazon reached 33.73 back in August 2020. Okay, it got rejected on a daily candle. So that was the first resistance point, right? These candles you'll here might go 33.80, 33.70, but this is the main number that matters. The number that the stock gets rejected the first time it reaches in its life. Okay, you're not gonna learn this from nowhere. No book, nothing. So let's say, for example, if a stock broke out of 100, it gets rejected at 107.50 for the first time, and it closes below, and then it gets stuck in a range. That 107.50 is the original resistance for that stock. It's just one of those numbers, right? And sorry guys, I just have to, that's good. Yeah. So that's how I get my numbers. And there's research involved in these, right? And you just have to look at the historically chart. And here, if it holds above this number, 33.72, and if there's a gap, we're likely going to see 34.30, 3,500, most likely. This strength is not normal. Justin, you can do credit spreads as well. They're the same thing, whether you're doing a credit. So let me just tell you guys an example. A credit spread and a debit spread, the price is always the same. So if you think a stock is not going to hold a certain level, yes, you can do the credit spread. I mean, keep that money, right? So yes, you could do those, obviously. So the spreads that you buy, yes, you can sell them as well if you think that the stock's not going to move enough. So for credit spread, for example, there are a lot of questions. I'm just trying to go through them. So for credit spread, which is known as a bear call spread, right? So basically, what he's asking is, let's say strike 133 and 135. So here, what you do is you sell the closer to the money or in the money call, and then you buy the further out for protection in case the stock goes higher. So let's say this 133 strike was selling at $2, and you buy the 135 at, for example, 0.75, I guess. for protection, and you think the stock right now is trading at $1.3350, just for an example, 133 and a 50. Here, basically, the difference here is $1.25 credit, which you keep. You keep this money, like you collect premium from the market, right? As long as the stock closes below 133, you get to keep this entire credit. If the stock closes above 135, right? If stock closes 136, now you're gonna buy this back at $2, right? So you lose 0.075, right? You lose this money. So this is your loss, and you gotta buy it back from the market for $2, right? So credit means you're basically selling premium to the market. If the stock goes sideways and you have spreads, if you're in the money spreads, your spreads will go up. If you're in the out of the money spreads, then the spread price goes down. Now, if you bought the spreads, you lose money. If you sold the spread, then you make money. I hope that made sense, right? No, there are no special requirements. It's just the same thing. You just do the opposite, and that's pretty much it. But just know one thing I do want to let you guys know. I've seen it over and over from multiple people. Make sure your execution is right. A lot of you guys screw up by messing up your expiry dates, right? You'll buy the April 16th, like for example, and then you end up selling April 23. And now instead of a spread, you're in some calendar call or put, which doesn't even make any sense, right? So make sure when you're doing this, your execution is right. A lot of you guys do them wrong. And I do get DMs from some of you saying that, oh shit, I did this, I put this expiry, did this, that, and that. Right. So that make sure you learn execution before doing it. Well, Joseph, I'm just talking about the expiry dates. Like for spreads, make sure the expiry date is the same unless you're playing calendars and stuff. Right. And hold on. Nilesh asked a question. Yes, level 3 and level 4 is what you need for Questrade, and your account has to be a 5K for level 3, I believe. Level 2 or 3, I think. Yeah, so your account has to be 5K, and for level 3 and 4, I think it's 25K, I believe. But you know what? For call spreads with a 5K account, yes, you can do them, right? So that I know I did confirm with the Questrade, but you can check unless they change their rules. But yes, a 5K account is required. And try sticking to the low price stocks when doing spreads on a smaller account so that your margin or buying power is not affected, right? And if you're new, then only stick with stocks with smaller prices. You don't want to be playing stocks, selling $100 call or anything like that, or a call that costs like $10,000. You don't want to be doing that with a small account. I am. Thank you. He made me tea for my headache. A stock holding a level, for example, now for Amazon just had a lot of strength. So if we were to go back to Amazon here that day on my 1-hour chart, this right here is you'll often come across these patterns. If you catch it, you will bank. If you catch this pattern, you will bank. Albie often goes in his charting videos, I think, right? When that trend 1-hour trend, it goes up and then it consolidates, holds the level, it goes up, and then it consolidates. As soon as it breaks a new high, you can play the new uptrend again, and then it consolidates. As soon as it breaks, and then you can play that again. And me, I caught this move on Amazon. I exactly played it like that. Played to the upside. On every consolidation, I would take my profit, roll into a spread, play the upside, spreads, upside, spreads, upside, spread. That's exactly what I did. Right? It did, Carson. It did. But that was on a daily chart. Well, Neo, what you need to now see, this is common sense. I mean, sometimes people end up falling in love with stocks. And I did mention in one of my previous sessions. Now, this stock, you need to ask yourself, this stock was trading below 250 in 2020. In the same year, it hit close to $65 from $2.50 and $65. I just ask yourself, does it make any sense? I mean, I'm pretty sure it's probably a great company. Maybe it goes to 1,000 in the future. I don't know, but within 12 months, that was a huge move, right? And this is a logarithmic chart that we're looking at, not linear, right? As somebody asked in the group. So basically here the scaling is not the same. So right now it's basically people that bought NEO above 60 are they're losing more than 40% equity. And how long will it take to go back up? I have no idea. It can be stuck here for years and years to come. Right? If you don't believe me, just look at Tesla. Right? Look how long Tesla was stuck here for almost 6 years. The same, and even before that, right? The same thing can happen to NEO. Even Tesla, don't be surprised if it comes down to 400, 300 in the coming months. Like, I don't think it will, but like at the same time, I do believe in things like this because I've just seen it so many times. They'll make you think like it won't, but then that's exactly what will happen. But now that they're with Bitcoin, things are different. So let's see what it does. Hard to tell. Okay. What determines when a stock is holding a level? So let's just go back to Amazon. I open up the 1 hour chart, right? And you can see here. So last week, basically with the strength, right? When the stock is just not falling, it's holding. It goes up, down, up, down, up, down, up, down. That's holding the levels right here, right? It's not just going down. Now this right here would be an example of not holding the level right here. See, this is not holding a level, right? It's weak. It's unable to break the previous highs. But here on the 1 hour chart, it kept holding all the levels, right? And then obviously it wasn't just Amazon alone. There were other sentiment in the market. And I just happened to catch this move and it worked. It was just about time. Looking at the weekly and the monthly, remember that, right? It wasn't just 1 hour candle. Maybe it would have totally failed. I don't know. But the main thing here is risk management. So increase in premiums, Hassan, that's just something that you have to watch out for. Now, for example, of the same chart right here, I spoke about Apple and I'll speak about Amazon. This move right here from 3,050 to 3,372, this move alone has increased premiums in Amazon by a lot, right? Many of you who talk about small accounts, let's look at Amazon April 23 calls, for example. Let's see what the 3390s were trading for 2 weeks ago. They were at 590. These 590 calls are now at 5035, right? So small accounts, yes, you can make money, but you have to be very picky with your trade, and you have to wait patiently, right? Your first thing here, you watch volume. See how this increased volume here, right here, 26th April, and the stock was just going sideways. There's more volume that came in here. And if you thought Amazon was going to make the move, you could have easily played something like this. And if you can put a 590 call, let's look at a different strike maybe. Let's look at a $3,500 strike. I'm not now that obviously would have been too far for me. I wouldn't have played it, but then at the same time, from 265 to 18, it's up over 700% right here, right? And look at the more volume that came in here, indicating that it's probably going to go higher, or it's either FOMO here, as one or the other, right? So so you see the increase in premiums here. I mean, they just took everything up. And increasing premiums, you just got to keep an eye out on it. It's not something is the volatility when the stock moves into one direction or like straight up or down. That's when the premiums they increase. Or if the stock is the ATR is high, like it's going up and down like crazy, like more than usual. Yes, you can sell weekly spreads, but for that you'd have to practice a lot. When I say practice, you would have to know what to sell. You can't just be selling spreads, right? For that is what. Okay, let me. Now that you asked me, I'll give you guys another recipe here. You will not learn this outside. This is something that I learned on my own. You'll have to learn probabilities. Probabilities, right? What do I mean by that, right? So let's go over this. If you're a numbers guy, you can learn these. This is something that I'm looking forward to doing. I haven't started doing it yet, right? But I will in another few months. Right now, we're just busy with some other things. Now, let's say, for example, if I have a 10K account, now we know one thing, stocks don't go up every week. Am I right? Like stocks don't go up every week. We know this very clearly, right? But here's what you could do. Stocks don't go up every week. Let's say worst case scenario, first week you end up selling a spread for, just an example, for $200, right? You sell a spread for 200 bucks. Your max profit is $200. Your max loss here was also $200, right? And you end up going in a loss. The stock actually went up. It did not go down. Okay. So now your account's at $9,800. This has nothing to do with, with the buying. I'm just going to give you guys numbers to go over it. Like what you could do in the stock market, the possibilities which are out there. Now, but again, with this comes your confirmation. It's not just something you're doing every week. You're waiting for the setup. Out of 2 or 3, you're likely to be right once or at least once or out of 2 times, you'll be right. Next week, basically what I'll do is simply I'll do a spread for $400 or maybe $300 max profit. And then my max loss is also $300, right? Let's say worst case scenario, this also goes against me. My account is now at $9,500, right? Next week, let's say I'm picky with my trade again. I believe in myself. I know exactly what I'm doing. Okay, this week it's not gonna go up. Maybe I'll go for something for break even, or I'll do something for $600 max profit and $600 max loss, right? Now I end up hitting this trade. My account now is sitting at 9,500 plus 600, 10,100. Now, this is just an example I'm giving you. This is not realistic, but if you were to do something like this in the market with selling spread, like, some people who collect premium do spread, this is exactly what they do. And this is how they make the big profits on consistency, right? They're just keeping up, down, up, down, up, down. It's a matter, it's just all probabilities, right? And then when you end up hitting this one, and there's a stock with resistance here, for example, Amazon, right? Each time it hit, like, let's just go here on the weekly, and you were selling credit spreads on Amazon, for example, right here, it was not able to break this resistance for how long? For how many months it wasn't able to break? You could have made money every single week. Every week you could have made money every single week. And as you were making more money, you would have increased your risk a little bit too, right? So these are things that you won't learn outside, but it's just something that you have to figure out on your own. You gotta fall in love with the numbers. So stock market is not just buying calls and puts or buying stocks. No, there's a lot more that you could do, a lot more. But then again, it just requires a lot of work, patience, and a lot of work. Anything else I can cover? Someone asked me about butterflies, I think. Somebody asked, yeah, butterflies, right? All right, guys, so butterflies are basically played when you think a stock will stay in a certain range. So butterflies, we'll do call butterflies. So call butterflies, they're played when you think a stock holds a certain range or ends up closing between 2 strikes, right, on expiry. So Joseph, they should have, I think they should have tutorials. Maybe call them. I mean, you pay them commission and stuff, you call them. I mean, eat their head. So for example, I was about to execute a butterfly on shop last week, which did not get filled. So let's do shop. Okay. So let's say shop, it has strength. For example, next week, I think shop has a chance with the market strength, even though it has left these gaps, that it might reach around this resistance right here, which is 1325, right? Around here. That it might reach this level next week sometime by Friday's expiry, around this level. So this is 1300, 1375-ish, this range. Maybe it doesn't, but maybe it does. But let's just say, for example, if it was true, right? How would I play? So I'd buy 1 call. I'd sell 2 calls. I want to show you guys exactly which one, and I'd buy 1 call. Now there's a little bit of math involved here. The difference between buy and sell must be the same both ways, right? So for example, on shop, if I chose to buy a 1300, let's just go with 1300, for example. If I chose to buy a $1,300 call, and I think the range was between 1300 and let's do 1350. So if the range I think is between 1300 and 1350 for next week, shops Friday expiry, right? Range between 1300, 1350. So my second call would be 1350 and my selling call would be 1325. Does this part make sense so far? So see, there's a difference of 25 points here. The smaller the spread, now the smaller the spread between these prices, if this was let's say 1340, no sorry, 1315, 1325 and 1335, my spread would cost me less. The bigger the spread, the more the butterfly will cost. Okay. Why? Because the $1,300 premium will be high. It's closer to the money. But let's say for example we were doing this. Now, so here, so shop, April 16, let's go on all strikes. So $1,300 call is selling for 11 bucks. This is at 11 and 1325 does not exist. So let's go 1320 just for an example. And then this also becomes 1340. And 1320 is at 862 and then 691. So 860 and 690, right? 860 and 690, yeah. So let's see the cost here. The cost for this your broker will calculate on your own. But sometimes one thing that you guys need to understand here is I'm going to tell you guys something. Just hold on. Let me just cover this first. So here we're buying one call, which is $1,100. So let's do the math here. You guys should know this math here. I know your broker does it for you, but let's do it by hand. Minus 860 times 2 plus 690, right? So how much would this be? Who's doing the math here? Anyone? It's 60 times 2, so 1100 minus 1720 plus 690, which is how much is this? 1100 minus 1720 plus 690. Nice. 70 or 0. Feels like a math class. But okay, so and next time we'll have rewards. I'll start sending a crypto to some of you guys for getting the right answers. Anyways, so here's the math right here, okay? So 70 cents. So this butterfly would cost you in option world 70 cents. Now, what's the max profit here? Max profit, you take the mid price. You take the mid price 1320 minus 1300, or the difference between the first two, which is 20 bucks. Okay. So $20 minus 0.70 equals 1930, or percentage wise from 70 to 1930. Check this out, 2,657%. And those of you that have known me for long enough, I think the last few months I've hit, I don't know how many butterflies over 1,000%. I've hit a lot of them. One is on the way, I think, which is going to be my biggest one out of all. It's on the way, which is Amazon, currently at 300%. So let's see. Let's see what that works out to be. Anyways, or 2,657%. Now, Shop's current price is trading at, what's it trading at? 12.27. Current price is 12.27. You're gonna get max profits on this only on the day of expiry if it closes exactly at 1320. Or if it closes anywhere between the range. Let's say it closes at 1305. What's your max profit? Just for example, if it closes at the, or you know what, give me a strike price that you guys want shop to close at between 1300 or 1340 or any strike price, any. Then I'll calculate the profits for you guys. Any? Give me one strike price, guys. 1317, okay. So 1317, because it's between the first bracket, so you take 1317 minus 1300, which is 17. So you can sell this butterfly on expiry for $17 or 1700, and your cost was $70, right? 0 minus 70. Your profits are 1600 and 30. Let's say you were correct on your range according to technical analysis, and you end up hitting this butterfly, right? And again, it's a numbers game. If you play butterflies, let's say you might be wrong once, twice, 3 times, maybe 4 times. But you know what? Even if you hit one butterfly over 1000%, that covers all your losses and leaves you with net. That's the reason I say position sizing is extremely important. That's the only thing that has contributed to my success. Like, I'll be honest with you guys, you know, for the last 1 year, my trading has only improved. There's just one formula that I figured out. Like, this is just my opinion. If you keep your position size consistent until you reach a certain level and then increase it again and keep it the same for, you know, until your account is up, you will make money. But if your account size is 10,000, for example, and you're using $500 trades, you hit the first one, you hit the second one, you know, your account's at 12,000, then all of a sudden you end up, instead of 500, you end up going with 2,000, you get greedy. And that trade goes against you, now your account's down, right? So if you keep your position sizing consistent and you educate yourself with the stock market, a lot of you guys have good trades. You actually buy trade, you have more trades which you make money on, like you have more winning trades. The only reason you lose is because one of your trades you just went in too heavy and it went against you. That's one of the biggest reasons people lose money in the stock market. Keep it in mind. So 1630 is your profits, okay, on 1317. Right? Why? Because the $1,300 call premium. So why is that? Is trading at 17, while these have gone to 0 and this also has gone to 0. Does this make sense now? Intrinsic value of how the profits calculated on a butterfly. But if it closes outside of this range on a Friday, then you lose money. However, if stock, like let's say this shop's trading at 1227, it moves up, but you have a small account, you want to play shop and you do a butterfly, this goes to 1260 the same day, for example. Hey, your butterfly has increased in price. Keep it in mind. This probably went from 0.70 to maybe $1. You're up almost 40% on your butterfly. You can sell. You can sell at $1. You don't have to hold it to expiry, right? The point of 1340 is you're protecting against the 2 calls you sold. Here you bought 1 call, but here you're selling 2 calls. Let's say shop, for example, if this was to close at 1500 next week, for example. Okay. Now you have 1 call, so you'll be able to protect against one of these calls. But then how about the second call which you sold? Right then, now that you have to buy it back. Okay. But if you have the same strikes, the levels that you keep here you save yourself. This is nothing but protection, right? This is nothing but protection against your sold calls. So that's the reason you sell the third strike. I mean, buy the third strike or the fourth, whatever you want to say. Yep. Yes, as long as it ends up between 1300, 1340, you make money, right? Well, by expiry, if shops at 1320, right, you make the most profit because if it's 12 p.m., 1320s will still have premium left. Okay. Let's say, for example, we're on the last day of expiry. Let's say on the last day of expiry, shops trading at 1320. It's 12 p.m. What exactly your price is? Let's see what this will be trading at. Let's say it's 12 p.m. shops at 1320. The $1,300 calls might be at 22 with $2 premium. 1320s will be trading around 6, as much as I know shop. And this will be trading around maybe 2. Right? Let's calculate our profits here. So 22 plus 2 equals 24. And then we have $600 times 2, which is $1,200. So your profit here is 2,400 minus 1,200. okay? But if shop for another 4 hours keeps dancing around 1320, goes up and down, this may go down, like maybe it loses premium to $2, let's say, for the end of the day, and this might just be 10 cents, right? For example, I hope this is making sense. I'm just going a little faster to show you guys. 4 and this $10, 22.10, and 22.10 minus 400 equals 1790. Make sense? So closer to the expiry, around 3:30, 3:45 p.m. when the mid price is losing all its value, that's when you make the most money. See, but here it depends. It depends. Amazon, I choose the butterflies I entered in Amazon. I entered them a couple of weeks ago, so I gave myself enough time, right? I bought them around. So earnings are coming up on Amazon. You guys need to know, right? In April, and the earnings are coming up. When Amazon was right here trading around these levels, right before this move even happened, right? When Amazon was trading at these levels, I entered an Amazon butterfly for April 23rd for 3,400, 3,450, and 3,500 for this range for April 23rd, right? And now the thing is for this range. And now the beautiful thing is because Amazon made this such a big move, unless it just skyrockets, which I don't know, right? I do have calls if it does, but it's probably going to take a breather around this level right here. Around here is going to take a breather. This is tough resistance. These lines is going to take a breather, and those butterflies will be up huge. And if I do get this range closer to my expiry, I'll walk away with 1,000, 2,000% on whatever's left. Or maybe I'll sell it before. I don't know. I mean, that depends on the market, right? So I have it for April 23rd. And I bought them when Amazon was around here, anticipating the run into earnings, and that's exactly what's happened. But that was another reason for playing Amazon like holding, because earnings are coming up and they blew last quarter and they're just so strong. I mean, why didn't they move? They held it down, right? What else, guys? Yes, any spreads that I do, call spreads, debit spreads, anything, always execute them at the same time. And Questrade is one of the best to execute spreads. The only thing I don't like about Questrade is the fills. Sometimes they give you fills at a higher price. That's my only issue with them. Right? I always end up paying 5, 10, 20% more sometimes. Right? And some of you actually buy the same thing I buy butterflies for 20, 30 cents less many times. And yeah. Okay, did you guys find this lesson useful today? I know there are a lot of more things that I wanted to cover, entry exits, whatnot. I think I'll do another proper session on those because it's not just something on a rush through. But that does make sense. The spreads, did you guys find it helpful? Like, can you guys use this for your knowledge? And again, another thing that you want to know, this is not something that you can just start executing it tomorrow. You want to know how these move. Many of you guys ask me, how come my spreads not in max profits, right? I want to discuss this. Some of you guys send me messages regarding this max profits. Let's say, for example, stock is trading at, just for example, stock is trading at 550, right? And you have the spreads for 560 and 570 at $4, for example, right? Now 560 calls were 560 calls when you bought them, they were going for $10, and 570 calls when you bought them, they were going for, sorry, when you sold, they were going for $6, and 560 were going for $10, right? And today, for example, just an example, let's just April 12th today, Monday. You guys need to understand, right? And this is for April 16th expiry. You guys need to understand both of these calls have premium included in them. There's premium in them. You're not gonna get max profits right away unless this goes like $600-700. Okay. But let's say next day is trading at $600, stocks at 600. What might this be at? Your 560 calls on April 13th, on April April 13th, your 560 calls will be, just an example, maybe 44 for an example, okay? With $4 of premium. April 13th, current price is 600, just an example. 570 calls will be 36 maybe, right, with some premium added. 44 minus 36, your vertical spread is worth $8 here, not 10. Okay, why? Because there's $6 premium added to this, which you still gotta buy it back for. But however, if the stock holds the 600 level or even 570 plus until Friday expiry, you will get the full $10 profit for this. Okay, this is making sense. Why you don't get the max profit right away if there's time left for expiry, unless the stock just makes a huge move. That's the reason many times I will close my spread 30-40 cents early. Why am I gonna risk? Butterfly, because it's cheaper. Sometimes verticals are expensive, right? And for here, 3,400, like Amazon vertical 34.50 butterfly and 3,500 cost me $1.45 for a 100-point range, right? But a spread would have costed me, like if a 100-point spread, for example, if I was playing with the same percentage return, it would have cost me a lot of money. It would maybe cost me 20-30 bucks, right? But the butterfly cost me $1.45 only for a 100-point range. Okay, and I don't need to hold it till expiry. I still paid, like, these were up over 300% on Friday closing. I could have sold them. That's great percentage. I'm not playing for max profit, but then I just see something that I can probably get 600, 700, maybe 1,000% on these. Okay. I do them silently. I don't usually post them in the group, but if you guys want, I can maybe try. The reason being is because a lot of you don't know the execution, right? I don't do them all the time. Sometimes I don't get too complicated, but I do like the iron butterflies condors because it gives you more ways to make money, right? I mean, February was one of the best months to do those, right? Play the ranges and but yeah, if you guys want, I mean, learn them, give me a shout in the group and then maybe we can start doing them. I don't mind. But then it's only worth posting it, doing them if somebody else is following them. But we can. Well, of course you can, right? Actually, for 5K can you'll have to check Questrade the levels for the margins. See what's available. You'll have to go on your Questrade account management or whatever brokerage that you use, right? And yeah. So guys, I think we'll call it here. And thank you for attending. I hope I was able to help. And we'll have a charting session from LB soon, sometime this week. We'll make the announcement. And this week is going to be big again in tech. So come online early, pay attention. There will be a lot of good plays, right? Just remember, keep your position sizing consistent and you will beat the market in the long run. I promise you. But go for it, Devinder. Yeah. But yeah, thank you guys. Thank you for attending and have a great night. We'll see you guys in the morning.